Hello everyone, it is Sunday, February 6th, and this is episode 49 of Odds Are, your S&P 500 weekly market forecast. All right, let's take a look at last week. Right, so if you remember from last week's episode, I said that we were going to make our way back up towards the midline, that the midline, the red midline was going to come down and we were going to come up and meet that, and that this is where we would see the true test on whether this was a dead cat bounce. I called that we would be going back up to the 4,500 level. We did breach that 4,500 level, went up, came back down, and closed right around that 4,500, 44.93 on the settlement. But you know, when we look at this price action, this is exactly what I was talking about. I said we're going to go up. That little bit of a hook at the bottom there, that bounce was not enough to just count as a dead cat bounce, and that we were going to come up, hit the midline, and then we would see if we're going to breach right past it or encounter resistance. Looking at this, it looks like we did encounter some resistance, but nevertheless, we did breach the 4507 breach point, so we did have a breach of the breach points, and we just made it to close within the expected settlement limit. That was a close one. I thought, you know, I said last week there was a very good probability that we could, you know, close outside of it, and we almost did. Like I said, we're only off by 5 points. So we closed within the expected settlement range, and the market direction moved as we predicted. So all in all, I think we, you know, called last week exactly spot on, and now we're looking to see what we're setting up for next week. All right, so let's take a look at the moving averages. So now with the upward, that big bounce, right, the second half of that possibly dead cat bounce, not calling it yet, we have now switched back into neutral territory on both the short term and medium term. So kind of a wait and see, which just lines up perfectly with that theory that right when we meet that midline is where we're going to have the make or break. So it's going to, you know, go one way or the other. We're going to go back up, or we're going to have that cat really die and drop even further. So kind of a wait and see right now from the moving averages. Long term still bullish, waiting to see what happens here in the next couple of weeks. All right, so let's see what we're forecasting for next week. Looks like we have another offset on the breach points versus the settlement range. So our expected settlement range is between 43.62 and 45.64, but our breach points, right, are 43.92 and 45.82. So the upper breach point is actually outside of the expected settlement range, which lines up again with this same setup I'm describing. If we breach to the top side, we could easily breach up with strength, get back out from underneath that red midline, and, you know, just completely eliminate any possibility that this is a dead cat bounce. We can really just start heading back up if we close above that 45.64, breach that 45.82, and sky's the limit. But looking at the downside, if we have that breach below 43.92, we could still close above 43.62, and then that's kind of that choppiness that stays below the midline, and we're looking more like just waiting for the other foot to drop. The parabolic SAR is now at 47.95, still well outside of the range of anything I'm willing to call, but, you know, just kind of slowly creeping down to match where the market's going to be. All right, let's wrap this up into the relative view. So looking at the relative view, you see what I'm talking about here. We're right beneath that red midline, really encountering some resistance there, and it looks like it wants to go down, right? We had a, you know, low on Friday, and then it came right back up to close above Thursday's low and Thursday's close, but still red. So if we're looking at this, I'm telling myself, hey, we're right in the middle of that Bollinger Band. It's all fair game. We can go up and get above that red midline and trade in the shaded area between the upper edge of the Bollinger Band and the red midline, or we can go back down. And really, that's why I was talking about looking at 45.82. That's above the midline. We breach that, we go up, and now we're in that upper envelope. If we go down to the downside, 43.92, 43.62, we stay in that range, then we could be setting up for a nasty drop in the weeks to come. All right, now, if you didn't see that one coming, you know, sometimes I have weeks where I ask myself, okay, did I miss something? Did I read the numbers wrong? Is there something wrong with one of my formulas? Do I have to go back and revisit my forecasting model? And I have to remind myself that these are odds. We are only going off of what the probability is. There's nothing definitive about this. But then there are other weeks where it just really hits me and I'm like, wow, I really called that spot on. Like, I could not have called that any better. And with that level of accuracy. And it's, I can't take all the credit because literally it's the numbers and it's the models that I've built that are giving me that information. And that's why I trade off of these systems, because there's no way that I would be able to look at this market and just, trying to rely on my own natural pattern recognition, see exactly what's going to happen. I'm sorry, I'm not that good. But with the systems that I have in place, that gives me more assurance that the numbers are informing what I'm seeing, and the numbers are backing the theories that I have and what I see coming down the pipe. Well, last week was one of those weeks where I just, I'm looking at it, I'm like, wow, I said we were going to go up, we were going to get around 4,500, we're going to get to that midline's going to go down, everything played out exactly. I mean, it was one of those weeks that just kind of reinvigorates my passion for the markets and why I do this show. So hopefully somebody out there in the grand vast internet caught what I was saying last week and was able to make some money off of it. If not, hopefully you'll continue watching the show. If this is your first time, welcome. If not, stick around, and there's only going to be more good things to come. All right, and with that, I'm going to wrap up with the quote of the week. And this is by Mr. Richard Dennis, who is a commodity speculator. He's part of the Turtles, and he actually is known as was known as the Prince of the Pit. This is going way back to the trading pits, when that's where all the action happened. Now most of it's online trading, but he was the Prince of the Pits. And Mr. Dennis said, "You should expect the unexpected in this business. Expect the extreme. Don't think in terms of boundaries that limit what the market might do." Now, it's funny because every week I get on the show and I literally draw lines on where I think the boundaries are, but I always put the percentage, the probability. I say this is not 100%. I mean, it could be a 99%, it could be 80%, it could be 71%, but it's still something that's based off of probabilities. There's no way that I can put a limit or think of actual boundaries that would constrain the market from doing something. If that's the case, I'm setting myself up to be wrong a lot. But if I expect the unexpected, if I go into it knowing, humbly accepting that I can only be led by a strategy that is right more often than not, and if I use proper risk ratios and risk protocols, then I'll come out on top. That's all I'm concerned about. I'm not looking to be right 100% of the time, and if I did, then this is just not the right place for me. But I love what Mr. Dennis says here, especially expecting the unexpected. We have to be ready for those. Sometimes you're gonna be wrong in a big way, but if you play the odds, you'll come out ahead in the long run, and that's what we're all here to do, right? All right, guys. With that, I'll let you go. Enjoy the rest of your week, and I will see you guys here next Sunday.